All right, good afternoon, everybody. How are we doing today? Hey, Ron, thank you very much. Merry Christmas to you and your family as well. Thanks, Ron, for joining us from Fort Worth, Texas. How's the weather up there, Ron? Nice and cold for you? Can I get a quick audio and video check while we're at it as well? Let me know that you can see my screen here and that we're coming through loud and clear. You can see me and hear me. All right, perfect. Thank you, guys. I appreciate that. Hey, Lou, how are you? Okay. Ron says, great day today. Should be on the golf course. Love it. Love to hear that. All right, well, let's get our recording going here. So welcome, everybody, to the Nadex Application and Strategy webinar series. My name is John Skelton. I'm with apexinvesting.com, and this webinar today is brought to you by and hosted by Nadex. So we appreciate them having us on here with them. And we'll talk a little more about that here in a minute, but you know, I got to give a lot of props to Nadex. They do a ton for their members. They give their members a ton of free education, free information, some great tools, some demo accounts. I'm going to talk to you a little bit about that here. So we appreciate all that they do for all their members and for having us on. So let's knock out our disclosures here. Today we're going to be talking about choosing the right Nadex spread for your strategy. If you've been with us the last couple of weeks here, you know that at times we cycle back through to the basics and we start with the foundations of, you know, the different products that Nadex offers, and we talk about how to choose the right products, some misconceptions, risk and reward. We talk, you know, that we keep building on that, and we talk about strategies and systems and some advanced stuff. And we're kind of, you know, in the middle of our cycle here of, you know, the foundational elementary things here. So for some of you, this might you know, be very elementary and be basic. You might have a good handle on this, but we know we've got a lot of new people that are always on as well. So we're glad to have you here. And I'm going to show you a little bit about where you can catch up on some webinars as well. So let's knock out our disclosures. As always, trading futures, options, or any financial instrument involves risk. May not be suitable for every investor. Information here in this webinar is for informational and educational purposes only. It is not trading advice. Guys, also, I'm going to be showing you the Nadex demo platform today as well. And if you see me do any type of order entries, entering and exiting orders on the Nadex platform, that's in no way a trading signal or trading advice. That's simply me trying to, you know, visually help you understand what it is I'm trying to teach you today, or, you know, help you understand how to use the Nadex platform and the Nadex order entry tickets. So, speaking of Nadex, let's hop on over to nadex.com. And basically, Nadex offers two different products. They offer binary options and spreads. And you can go through these couple of tabs here and get some good information about, you know, the basics of binary options, the basics of spreads, you know, what different markets that they offer them on, and some of the contract specs. I want to bring your attention to a couple of places here. Right here under the Learning Center. If you go right here to webinars, this will show you all of the upcoming webinars that are on the schedule for the next few weeks. That way you can, you know, get signed up for those, get registered for those webinars, and get reminder emails about them as well. So make sure to get signed up for those upcoming webinars. Down here you've got videos, trade examples, ebooks, some FAQs, some great information there. But right here under Webinar Archive, okay, if you go right here to Filter by Presenter, drop down and find us right here, Apex Investing Institute. If you've missed some of our past webinars or the last couple weeks webinars, this is where the recordings are, and this is where today's recording will be placed as well. Okay, so you can always go back, rewatch a webinar, or catch up. You know, if anything we cover today is kind of over your head, or you're not really sure about some of the basics, we're not going to really review the basics of spreads today. So this webinar kind of assumes that, you know, you've been with us the last couple of weeks and you understand the basics of Nadex spreads, which we covered a couple of weeks ago, or that you understand risk and reward. And so if you need to go back and catch up on those, here's where you can go and find those recordings. But you can go back and find all kind of great information about basics of spreads, binaries, different ways to trade them, you know, premium collection strategies, morning breakouts, everything from the basic fundamentals up to advanced strategies and systems. So you can check that out right there. Again, a lot of great information from Nadex there that they provide you with. Right here to trading platforms. You can go directly to the online Nadex platform. They have a great mobile app for your Android smartphone. But right here, demo trading platform. If any of you on this webinar right now do not have a demo account, go ahead and sign up for one right now while we're even on this webinar. All you gotta do is enter your name, email, and create a quick username, and then hit Open My Practice Account, okay? Once you do that, in just a few moments, you'll get an email from Nadex with a temporary password, and you can log right into a demo account, okay? And once you do that, you can go right here to My Account, and then go right here to Settings, and then go to Password. And you'll be able to change that temporary password to whatever you'd like it to be, something easy for you to remember. But the Nadex demo account, they'll give you a $25,000 free demo account. It's a great place to try out new strategies, new systems, you know, really master your strategy or system using demo money, not using your live money, right? It's a very expensive way to learn when you're using your live money to make mistakes. So utilize the demo platform, testing out anything new, but also just to get familiar with Nadex, get familiar with the different binary contracts that they offer, what markets they offer, you know, the different expirations, how to enter and exit orders, the different spread options that are out there. It's a great place to really get familiar with them. So make sure to get a demo account if you don't have one already, okay? Apex and Nadex, two complete different separate companies. Nadex is an exchange. Apex, we're an online education company. We're a group of traders helping traders. We've got over 20,000 members. We have, you know, indicators and strategies and systems and live trade rooms, and a lot of our systems focus on risk management and probability. That's why we love the capped risk products of Nadex. And we're a Nadex education partner. We do these webinars for them several times a month, again, just to help you understand who and what is Nadex, you know, how the products work, some different ways you can trade them. We're traders just like you, okay? We trade Nadex binaries and spreads every day in our trade room, and you know, we love them. So again, my name is John Skelton. I've been with Apex now for about 4 years as head of operations. I've got a background in the banking industry and as a stockbroker. I'm an educator, but again, a trader just like you. So that's what we're here for. So let's jump right in. Today we're going to talk about choosing the right Nadex spread for your strategy, okay? And, you know, something, a lot of times when I'm teaching spreads, you know, I tell people, look, what you have to do, because some of you guys are familiar with Nadex and you're familiar with Nadex binaries, okay? And one of the biggest struggles, if you're a binary trader and if you understand binaries, one of the biggest struggles for you to start learning and trading spreads is in one sense, you have to forget what you know about binaries because spreads work completely different. Okay, you cannot look at spreads the same way you look at binaries because they work very different. We talk a lot about that in the last couple of webinars here. But, you know, let's say that you do know binaries. Let's say that you are a binary trader, okay? Well, you know that if you pop over here and let's just say we want to look at the derivative of the Dow Jones, right? And we pull up the Wall Street 30, which is the derivative of the Dow, and we pull up these binaries. We know that we've got a bunch of different binary strikes here, right? We've got a bunch of different binary strikes, and right here is the price that we can sell them for. Right here is the price that we can buy them for, okay? So something we do know about binaries here. Let's talk about binaries for a quick minute, okay? Because like I said, in one sense, you have to forget what you know about binaries because spreads work different. But there are certain things that if you understand binaries and you put some of that same mindset into spreads, they'll make more sense as far as what we're teaching today. So what do we know about binaries at expiration? How does a binary work at expiration? It's either 0 or 1, true or false, yes or no, all or nothing, right? At expiration, a binary is either worth 0 or it's worth 100, correct? Now, if I were to buy this binary right here, okay? Let's just do a quick little example here. If I was to buy this binary right here, I'd buy the binary for $33. And if I'm correct, because what is a binary? It's just a statement, right? That the Wall Street 30 will expire greater than 24,857 at 3 p.m. So if I buy this binary for $33 and I'm right, and the market expires greater than 24,857, then how much is this binary going to be worth? Well, if I'm correct, it'll be worth $100, right? So what would I profit on that binary? What would I make? Well, I'm risking $33 and I would make $67 of profit minus my fees, right? Simple. Everybody's got that. Okay. Well, so I'm buying this strike right here, 24,857. Okay, let's pull over a chart of the Dow. And let's find 24,857. So here's 24,850, here's 860, so about right there, right? 24,867. That's right, that's the strike I would be buying. That's the price I'm buying in at, okay, the strike. All right, cool, and I'd make how much? $67. All right, so if the market is right here at 24,845, and it moves up here to 857 and above it, then that binary would be profitable. I'd make $67, right? Okay, cool. What if I buy this binary right here? Okay. What strike am I buying here? 24,833. Okay, so let's take a look at that. Where is 24,833? About right there. Okay, and let's say the market does the same thing. It moves up here and it goes above this one here at 57 and expires in the money, right? Well, how much do I make then? If the market does the same exact thing, moves to the same level. Well, on this one, I'm only making how much? $25.75. Well, wait a minute. On this one over here, I was going to make like $67. But on this one down there, I'm only going to make $25. But why does that make any sense? Because I'm still saying, but the market's going to move up here. In either scenario, the market's still going to move to the same place by 3 o'clock. Why am I making $67 on this one, but only $25 on this one, when I'm still talking about the same movement of the market? The market's going to move the same number of points either way. Why am I making less on one than I would another? That doesn't make any sense, does it? No, it makes perfect sense. Why? Because the market may move the same amount of points, but what's the difference? The difference is where I'm choosing to get into that market. Where is the strike at that I'm choosing? Correct? Where on this chart am I choosing to get into that market, or get into that trade, or get into that strike? So the market may move the same amount of ticks either way, the same amount of points either way. The difference in my profit here, or potential profit, is where I'm getting in. That makes perfect sense to all of you, right? Especially if you understand binaries. That makes perfect sense why you're making more on one and less on another, because it's about the strike, okay? And if you think of that as, hey, it's about where on this chart am I getting in, okay? We're still talking about the market moving the same amount of points. We're not talking about different market movement. We're, in this example, saying the market's going to move up here. What I'm going to make off of that move depends on where I got into that market. So that makes perfect sense from a binary standpoint, if you understand binaries. So now, if you go back and watch the last couple weeks webinars about spreads, and you hear me talk about and explain how spreads work completely different than binaries. Okay, it's not all or nothing at expiration. Okay, spreads are $1 a tick or $1 a pip, right? So on a spread, wherever I got into that spread compared to where I get out or compared to where it expires, my profit or loss is going to be $1 per tick compared to where the market was at on exit or expiration compared to where I got in. Okay, it's not all or nothing. It's $1 a tick for the difference. All right, everybody got that? That's how spreads work. It's not all or nothing. It's $1 a tick, profit or loss, compared to where I get in and where I get out. So what we want to talk about today is just like with binaries, okay? You have different reasons to choose different binaries, right? If you as far as getting an out of the money binary, an at the money binary, or an in the money binary, that's going to all be based on your strategy or system and be based on what the market is doing that day, right? If we don't expect a lot of movement in the market, we might be looking for an in the money binary, right? If we're not really expecting a market to move a whole lot to go up any further, we're expecting to just kind of sit here, well, then we don't want to buy a cheap binary way up here. We may want to buy one down here that's in the money already and just let the market kind of, ride there till expiration, right? If we're expecting a big move in the market, then maybe we want a lower cost out of the money binary up here because we're expecting a big move, right? So it's all about the strategy or system. It's all about what you're looking to do that day. Is the market trending? Is the market range bound? And that has a lot to do with which binary option we choose, right? Everybody understand that? All you binary traders? Makes sense, right? Okay. Well, we need to take that same line of thinking over to spreads. Okay, so we want to talk about some common misconceptions, how to pick the right spread. We're going to talk a little bit about premium and pricing and how the value of a spread works. Okay, this is probably the #1 biggest mistake that people make when it comes to trading spreads. So I want you to really make sure you get this, because if you truly understand this webinar and the one I did last week about risk and reward, okay, those are the top 2 misconceptions about spreads. And if you get those 2 things right, it will completely make all the difference in your trading of spreads, okay? And it could mean the difference of success and not success of your understanding of spreads, okay? Doesn't mean you're going to be guaranteed any kind of success of trading and knowing where the market's going, okay? But to successfully and properly understand how spreads work and be able to therefore have the knowledge to pick the right one just gives you a higher probability all around, okay? So again, you can't think like a binary trader of, how spreads actually work, because it's not all or nothing based on 1 tick or 1/10 of a tick, okay? It's 1 tick or 1 pip is $1. We talked a lot last week about don't be confused on max loss, right? Your cost to get into a spread could be a little bit more than a binary, okay? But again, it's not all or nothing, okay? It just costs you a little more to get into the spread at times, but you can exit early. Max risk is different than realistic planned risk. So you may tie up more of your account to place the trade, but it doesn't mean you're risking that full amount, like on a binary, of all or nothing, okay? So make sure if you missed last week's webinar, about, do you really truly understand risk and reward with spreads? Make sure to go check that out. so that you know, have a good understanding of that. So like we covered, just like multiple binary strikes to choose from, there are multiple spreads. All right, and let's take a look at that. Let's take a peek here. So we were looking at, when we looked at binaries, we were looking at the derivative of the Dow, okay, the Wall Street 30. Let's look at that. So just right now on spreads, we've got some spreads that open at 12 p.m. and expire at 2. We have some that opened at 1 and expire at 3. We've got spreads that opened this morning at 8 a.m. and they expired today at 4:15. Again, all these times listed on Nadex are Eastern time. And then we've got these daily spreads, which opened up last night at 6 p.m. On the daily spreads, we've got 4 different spreads here. And notice they each have different floors and ceilings. Okay. On the 8 a.m. to 4:15s, we've got 5 different spreads with different floors and ceilings. Okay. On the 2-hour spreads, it's the same thing. We've got 5 different ones there. Okay. Now, let's take a look at something. Okay. And let's pull these up right here. So we've got different floors and ceilings. We've got different expirations. Notice these spreads right here from 8 a.m. to 4:15. These spreads go from what? 24.9 to what? 25.2. So how wide are these spreads? 300 points wide, right? What about these dailies right here? They go from what? 24.7 to 25.1, 24.5 to 24.9. Those are 400 points wide, right? What about these 2-hour spreads? 1 p.m. to 3 p.m., right? 900 to 5,000, 850 to 950. These are 100-point spreads. So not only do you got different time frames, not only do you have different expirations, not only do you have different floors and ceilings, you've also got different widths of spreads. Okay, and we talked a lot last week about that and about how, you know, depending on the width of your spread and where you get in, that determines your risk and reward. But I want you to take a look at something here. We know that the bid is the price we can sell for. The offer is the price we can buy for. Look at the difference here. I can buy this one for what? 24,902. I can buy this one for 24,866, 849, 834, 798. That's a pretty big difference of where I can buy into these spreads, isn't it? You know, so when we're just learning the basics of spreads and we think, oh, it's $1 a tick. So wherever the market is right now, I just get in and, you know, goes up 10 this way, I make 10. Goes down 10 this way, I lose 10. Okay. Well, remember how we talked with binaries and we showed the example on the chart? All binaries are not equal. At expiration, they're either worth 0 or 100. But which binary did you choose? What price did you get in at? What strike did you get in at? That determines, even in the same move of the market, you know, let's say the market moved 20 points up. Well, that doesn't mean that any binary you buy is going to make the same amount of money, is it? Even with the same 20-point move. You're going to make based on what strike or price you got in at. It's the same way with spreads. Okay? Same exact way with spreads. Let's make it a little simpler. Okay? I've been showing you here the Wall Street 30, and there's a bunch of different strikes. And let's look at forex. Let's pull up the euro dollar, and let's look at these spreads right here. The 1 p.m. to 3 p.m. because there's only 3 of them. So what do we know here about these spreads? Okay. Well, let's look at the prices. We got 1875, 1867, 1863. We've got different prices on these spreads, don't we? So if we buy one of these spreads and the market moves up 10 points. Okay? So let's take a look. Well, first of all, let's establish a foundation here. Who can tell me when these spreads opened up at 1 o'clock? Because these spreads go from 1 to 3. Who can tell me approximately where was the market at 1 p.m. without looking at a chart? Just by looking at the screen, where was the indicative price of the euro dollar at about 1 o'clock? All right, let's say at 12:58. Yep, Lau, exactly. 1870. How do we know that? Well, Ernest got it right too. Well, because that's how spreads work. Look here. On the euro dollar, for example, on these 2-hour spreads, how wide are these spreads? 1870 to 1970. 1820, 1920, 1770, 1870. They're 100 points, 100 pips wide, right? So notice right here, this first number is called the floor of the spread, or the bottom. This number is called the ceiling of the spread, or the top, right? Spreads have a floor and ceiling, a top and a bottom. So notice the top of this spread is 1870, and it goes down 100 points, or 100 pips, right? Well, this spread, the bottom or the floor is 1870, goes up 100 points, right? Make sense? So if we're looking at the euro dollar here, let's see here. Let me just pull this in a little bit. So at 1 p.m., the market was where? Right about 1870. So what they did, right about here, okay? So they made a spread that had a floor of 1870 going up to 1970, right? Going where the market was right then, up 100 points. Then they made another spread that was at 1870 was the top of the spread, right? Going down to 1770, going down 100 pips. That makes sense? That's how they make the spreads, right? When the next 2 hours is going to come up, you know, right there before the new one starts, okay, where's the market at? Let's make a spread wherever the market's at now, a spread that starts there and goes up 100, that starts there, goes down 100. And then what they're going to do is what? So that makes sense? Why those two numbers are the same? And then what's right here in the middle? 1820 to 1920. So these are 100 pip spreads. So what would half of the spread be? 50. So what is 1820 plus 50? 1870, right? So let's draw it out. So basically 1820 right here, see 1820? So 1820 up to 1920. There's another 100 pip spread. So everybody got that? At 1 o'clock, the market was right here. So 100 point spread going up, 100 point spread going down, and then one right in the middle with 50 up and 50 down. Okay? That's how they determine the spreads. Make sense? So let's talk about something here. If I was wanting to buy, let's say I thought the market was going up. So I wanted to buy this spread right here that had a floor or a bottom of 1870 and could go, and I could profit up to 1970. Well, I'm going to be, the market's really, you know, the market's just right there close to the floor, isn't it? So I'm not going to have a whole lot of risk in that trade, am I? Because the market can't go against me a whole lot, right? Because I don't lose any money below the floor. Does that make sense? Let's take a look at that. So this spread right here, 1870 to 1970. Let's click it. Where can I buy it right now? I can buy it at what? 1876. Okay, so if I say I wanted to buy it, so if I'm buying at 1876 and the floor is at 1870, that's only 6 pips difference, right? So what's the most I can lose on that trade? What's my maximum loss, my maximum risk in this trade? $6, right? Everybody get that? So that's a pretty low risk trade, isn't it? I like that, don't I? I like that protection. I like that it's very low risk, and it's kind of like an insurance policy I have there, right? Protection policy. I'm protected at 1870 because even if the market goes way down, like I think it's going up, but if I'm wrong and it shoots way down here 100 pips, that doesn't matter to me because I only can lose to the floor, right? So no matter what, I'm only risking $6. That's a pretty nice protection to have in the world of trading, isn't it? You know, if you're a spot forex trader and the market flash crashes and goes, you know, drops 300 points, 300 pips out of nowhere, boom, you lost that, right? Whether you had that much in your account or not, you could lose your whole account and still owe the broker money, right? So to have that kind of protection, to be able to trade the euro dollar, right, for only a $6 risk and mimic the market, mimic the euro dollar trending with a $6 risk, that's pretty incredible, isn't it? Like for those of you that understand the world of trading, especially Forex, that is an incredible thing to be able to do. That's an amazing insurance to have, protection to have, okay? But you have to understand something. If you're buying it right here at 1876, where are you buying it at? Let's take a look here. Let's just zoom in a little bit. So 1876, so here's 1880. So 1876 is about right here. Everybody see that? So that's where you're buying into this spread, right? Okay, any questions up to now on what you're visually seeing? Because if you get this, it will change your world of understanding spreads. Quick show of hands here. How many of you have tried to trade spreads, or when you first started trading spreads, you're like, man, I bought some spread, the market moved 20 points in my favor, so I should make 20 bucks. But I only made like $7. These spread things don't work. I don't get it. These things aren't right. How many of you have done that? Yeah, Ron, right? Greek confusion in the beginning. Yeah, I've done that, right? You're like, I don't get these spreads things. It was supposed to be $1 a tick, and the market moved 20 ticks. I didn't make $20. What's going on? Something's not right here, okay? Well, okay, so if we bought in right here, and what were we buying in at? 1876, okay? What do we love about this? We love a $6 risk to trade the euro dollar, right? It's amazing. We bought in, okay, remember we talked about, okay, the reason we love this so much is a $6 risk. And what do we call that? Or what do we like about that? Because we're protected. It's insurance, right? Okay. Think about something that you pay every month as a bill with insurance. What are some of the things you pay every month in your personal life for insurance on? House, car, right? And what do you call that? Every month you pay your insurance premium, right? It's a premium you're paying. You're paying a premium to have that coverage, to have that insurance, okay? It's the same in the world of options, okay? So you're buying at 1876. You love it because you're buying right here at 1876. You can't lose money past 1870. So it's $6, no big deal, love it. But where is the market right now? The market's at 1865. You bought at what? 76. Now it's at 1866. So you bought 10, where you bought into this spread was 10 pips higher than where the market currently is. You see that? Everybody see that? Did I lose anybody right there? Okay, so the market moves 20 points in your direction. You were correct. And it goes from 1865 up to 1885, right? It moves 20 points in your direction. In your head, what are you thinking? Okay, spreads are $1 a pip. When I bought my contract, the market was at 1865. Now that the contract's expiring, it's at 1885. So that was a 20-point move, 20 pip move. $1 a pip, I should make $20. How come there's not 20 extra dollars in my account? These spreads don't work, right? You've done that before. Hey, when I pressed enter on my trade, the market was here. Now it's 20 points higher, 20 pips higher. $1 a pip, I should make $20. Why am I not? Well, if I bought at 1876 right here, which is where I bought, right? If I bought at 1876 and the market went to 1885, how many pips from where I bought compared to where I get out at 85 is that? It's 9. Does that make sense to everybody? Is there any newbies here going, aha, light bulb, got it? Because you're sitting there going, these spreads things they're a ripoff. Because when I pressed enter, the market was at 85 or 65. Now it's at 85. And that John guy from Apex told me on that webinar that it's $1 a tick. Why didn't I make 20 bucks? I only made 9. Well, because that's where you bought in. And with a low risk spread like that, when you're protected right at the floor or ceiling, you're going to pay a little bit of a premium price for that protection. Okay? That difference is called premium. Does that make sense? Where the market is now compared to where you can buy in on these real low risk spreads is called premium. So the market does have to make up for that. Does that make sense? Now, if you entered this trade, so Dario says, entrance minus exit equals gross profit. Exactly. Minus fees equals net profit. Exactly, Dario. Yes. It's not where was the market at when I bought compared to where it's at when I get out. It's where did I get in compared to where I got out. It's no different than talking about binaries, right? Well, the market went up 20 points, 20 pips. Okay, well, if the market went up 20 pips, does that mean you should make the same amount on any binary? No, because if you bought this one for $20 and it went up 20 pips, you'd make what? 80 bucks. If you bought this one right here and it went up 20 pips, you'd make 10 bucks. So the same movement of the market does not mean the same amount of profit on any contract. It's about where you get in. Does that make sense? Does that make a little more sense now? Okay, let's go back and look at something. What about this spread right here? Let's say I wanted to look at getting this spread. Let me say I want to buy one. What is my risk amount? $45. Okay. Here's the biggest mistake people make with spreads. Because when you don't understand this, you're looking at your chart, your strategy, your system, and you're saying, I want to buy. I think the market's going up, right? So what do? As a newbie, here's what you do. I'll show you what you do, because I know exactly what you do. And don't try to lie to me and tell me you didn't do this the first time, because you know you did. Market's going up. I want to buy. So let me click this top one. Okay, so if I buy this one, my risk is $4. Cool, I like that. What about this middle one? If I try to buy this middle one and I click it, I want to buy one. Ooh, 45 bucks. Ugh, okay. And how about this one? If I say I want to buy this one, let me click it and say one. Whoa, 93 bucks. Okay, I don't like 93 and 40. I'm just going to buy this one because it's only a $4 risk, and I think the market's going up. I'll risk $4. Let's press enter and get that trade. Show of hands, raise your hands, say something in the question box here. How many of you have done that, and that's exactly the way in the beginning you were picking your spreads? Right. And then what did you do? Oh, I picked that spread because it looked like a low risk. And then what'd you do? Then you're ticked off later, right? Because you're like, what the heck, man? The market moved up 20 pips. Where's my 20 bucks? I only got 9. Do you see now why that happened? Because you chose this, yes, low risk spread. You paid a little bit of a premium for it to have that protection. So your risk was very low, but where you bought in, the market was down here. So when it expired 20 points up, you didn't make 20 points because you didn't get in right here. You got in right here. Makes sense. Okay. Now, some people say, well, man, when you got low risk like that, that's awesome. Why would you ever trade this one in the middle and have to put up $45 out of your account instead of $4? Like, why not just always do those cheapy ones? Where is the market at right now? 1865. See that? Everybody see the indicative right there, 1865. Where can I buy this spread? 1866. Only 1 pip difference. Is there a bunch of premium built into this one? No. If I bought this one and the market moved 20 pips in my direction, I'm going to make 19 pips. I'm going to make almost that whole 20, right? Because I'm getting in right where the market is. Does that make sense? Can everybody literally see that on the Nadex platform? 1865, 1866. See that? It's right there. So let's visually understand that. If I'm getting a spread that's right at the floor or ceiling, and I have really low risk protection, I'm going to pay a little bit of a premium for that, right? But if I get into one of these, what we call the middle spread, where the market's in the middle, I'm going to be able to get in right close to where the market is, and therefore mimic the market tick for tick, dollar for dollar, like trading the underlying market a lot more. Does that make sense now? Does everybody understand that basic concept there of why there's different prices on different spreads? Because it's all based on how close to the floor and ceiling you are. So any of you that have said, I don't get these spread things, I just got the cheapest one and it moved 20 points and I didn't make $20. They don't work. Do you see now they actually worked exactly like they're supposed to? You just chose the wrong one, or you weren't looking at the prices. You were looking at this number, max loss. You weren't looking at where am I actually buying into this market. Okay, so with spreads, all right, when you're getting in close to a floor or ceiling, you're going to pay a little bit of a premium there because you have that protection. When you get into one of the middle spreads, yes, you got to put up more money. Why? Why do you have to put up more money on this spread? Because how does your risk determine? If you buy in right here, where's the most you can lose to? Down to the floor. So you have to put up out of your account whatever amount of money that is from the floor to where the market is right now. So you've got to put up a little more money out of your account to get into this one. But getting into these middle spreads, you're going to be getting in right closer to where the market is to mimic the market movement. Now, does that mean just because it says that's your max loss, does that mean you have to take that full loss? Or can you exit if the market's going against you and get out? You can get out. It's not like a binary all or nothing. So, real quick here. Okay, does everybody get that concept right there? I know there's a couple questions come through here. I'll get to those, guys. I'm not ignoring you. I'm just trying to make sure we nail home this. Does this make a lot more sense to you now of how the spreads work and why that happens with your P&L because you didn't look at where you bought it? So now now that we've explained that on a smaller scale here, let's take a look at something. If we go back over to the indices and let's pull up the Wall Street 30 dailies, how wide are these spreads? 300 to 700, right? You see that? Okay. So what if I wanted to buy this particular spread right here? Oh, wow. $336. Forget it. I'm out. Let's find something cheap. Right? Don't think like that. I'm not saying that's the spread you have to choose. But you have to realize, hey, when you get into these bigger daily spreads that are a lot wider, meaning you've got a lot more room to the floor or to the ceiling, then you might have to put up even more to get into, spreads that are closer to right where the market is. Okay? That makes sense? Now, some of them aren't that far away. You just have to look. Where's the market at right here? 24,835. Well, here's 838, 836, 837. Those are pretty close. So you can look at the different ones and see, okay, well, what about this one up here? How much would I have to put up here? Okay, that one's only 137 to get into, and it's only 2 points away from where the market is. Okay, that one I had to put up 400. That's only, that's like right at the market, 835, 830. That's only 1 point away. But I can give up 1 extra point to only put up 137 instead of 300. You have to look at that. You have to weigh, the risk and rewards, the pros and the cons. That makes sense? So you always have to keep in mind, not just what are you putting up to get in the trade, but where are you getting into the trade? Okay? And so if you understand those things and you really pay attention to those things, that will make all the difference. Okay? So let's go back over here and let's talk about a few things. So what are some of the reasons I would choose one over the other? Right? Well, yes, some of it may be based on how much, what account size I have, what is my risk tolerance. So let's say that whatever my strategy or system is and whatever the market condition is of that day, hey, the market's making some, some moves down and some moves up, and okay, it's making some decent moves, but I'm not expecting hundreds of points move. I'm just expecting a, 20 or 30 pip move up, and then a 20 pip move down, and a 20 pip move up, kind of ranging. So if I'm, okay, fine. So I'm trading my strategy or system, trying to get, take advantage of these 20, 25 tick moves up, 20, 25 down. Do I then probably want to look at a middle spread that's going to mimic the market just $1 away to mimic the market of 20 up and 20 down? Or if I'm only expecting a 20 pip move, do I want to give up, 11 pips of premium for that move? Does that question make sense? If I'm just expecting a 20 or 25 pip move up or down, I'm looking, kind of ranging market, I probably want to mimic the market as close as possible, utilizing a middle spread that I can buy into or sell into as close as possible to the market, right? Because I'm only expecting a small move, I don't necessarily want to give up half that move for premium. Make sense? What if it's a big trending day? I'm expecting a big move in this market. There's some news about to come out in the euro dollar. Okay, well, maybe then I would say, hey, I'm expecting a good size move. So I don't mind, giving up 10 points of premium if I'm going to get a 100-point move, right? Plus, if I'm expecting a big 100 pip move, maybe I want to get in on one of these 2-hour spreads as close to the floor as possible to get as much of that move as possible. Or maybe I want to look at one of the big daily spreads that's got a couple 100 points in there still, right? Because I don't want to limit it. Over here, if I got into this one, yeah, I would not be giving up those 10 points of premium or 10 pips of premium, but I'm also limited to this 50 or 60 that's left in the spread as opposed to getting closer to 100 out of this spread. That makes sense? So I'm expecting a big move, so I don't mind giving up a little bit in premium. Because what if I'm wrong and that big 100-point move, hey, there's news coming out. Historically, this news event moves the market 100 pips. But what if that news is bad and it moves at 100 the other way real quick, right? So I'll pay a little bit of premium to be protected here, hoping the 100 pips goes in my direction. But what if the 100 pips goes the other way and it just shoots down? Well, hey, I'm protected right here. Does that make sense, guys? As to where if I did that over here and it shot down out of nowhere, 100 point, man, I lost every, wow. Do you see the difference? The two different kind of strategies there? Okay, Dario, does that help explain or answer maybe your question there? You said, okay, I got it. My question is, which one of the three saddles do I put on that blind horse? Okay, does that help a little bit to understand why you would choose one of these over the other? Depending on the market condition, are you trading news? What's the strategy or system? What's the expected move of the market? Okay. Bob, that's correct. That's correct. That first little bit of movement there, you will go up in value from the move here to here, Bob, right? Just because of the optionality. But you're not going to mimic it like $1 a pip, mimicking the actual underlying market unless you're buying in right at the underlying market in the middle of the spread. And it will start to move slower in value as you get towards the top or bottom, just like a binary any optionality would do. Okay. Yeah, and Ron earlier said, looks like not a good strategy in a ranged market. Needs some volatility. Exactly. If it's just a ranging market, you're just expecting kind of 20 or 30 pip moves, you're probably better off looking at the middle spreads, not, ones closer to the floor ceiling. Dario says, so profit equals entrance minus exit. So as long as the strike price falls within the range I select, up or down. Yeah, exactly, Dario. Yep. It's wherever you bought or sold compared to where you get out or where it expires. And your profit and your risk are capped within this floor and ceiling, this box. It's like trading in a box. Your profit is capped. Like if I was in a buy, my profit is capped at the top of the box. My risk is capped at the bottom of the box. Okay, so wherever I buy in, whether it's in this box or even if I are out of the box or whatever, you know what I mean? It's where, where I got in or, compared to where it expired, but within that box. Like there'll be times you might see a spread, that to buy it, you have to buy it, there might be a price that's outside of the box. Okay, but your profit's still only determined from, the edge of the box to where you got out. Does that make sense, Dario? And most of the time it's in there, but with high premium days, you might find like you want to sell something. Well, you sell it up here, but you don't actually make that money. You can only make money from here to here. It's premium. Okay. Ron, do you prefer to enter as close to at the money when you can? Ron, again, it all depends on my strategy. Okay. Paul, can I exit a market early? Yes, Paul. Yep, you can exit early. You can hold it till expiration or you can exit early. So for example, Paul, let's say that I bought this spread right here. Okay. Again, this is not a trading advice or a signal. This is me just showing a quick example. So let's say that I bought this spread right here as an example, Paul. Okay. So in my demo account here, I bought this spread. So the spread I bought was the 24.5 to 24.9. Okay, this one right here, 24.5 to 24.9. So I bought that spread. What can I sell that spread for right now, Paul? 24.834. See that? That number is also right here, 24.834. So I bought it at 836, Paul. See that? And it says +1. That means I bought. If I had sold, it'd say -1. So that's the price I bought in. Here's the current market price, which is the price that I could sell it for. See that changed to 835? So did that a second ago. Now it's back to 34, 35. See that? So this profit and loss number right here, Paul, That is what I bought for compared to what I can now sell for. See the difference? 36 to 34, so I'm down $2. So as the market starts going up, let's say, okay, let's say the market goes up 20 pips or whatever, and let's say that this number goes up 18, 19 pips, then showing me 18 or 19 in profit, I could just exit the order right then. That makes sense? Or Paul, say it's going the other way. Say I thought the market was going up, I'm wrong, the now market's going down. And so this price is getting lower and lower, and I'm down $20. Okay, hey, I was wrong in my direction, let me exit. So I can hold till expiration at 4:15 or whatever it is. Or if I want to get out early, so Paul, you see this, it's in my open positions right here. Well, I bought it. So for me to get out of it, I have to sell it. So all I have to do is click the order. It automatically pulls up an order ticket marked sell, and I can place that order. I can do a limit order at a certain price here, or I can just do a market order, and I just place the order, and it exits the order. See that? It's gone. So I can hold it, or I can just exit early. Whether I'm exiting early as a stop to protect, you know, or exiting early being in profit. Okay, perfect. Yeah, so Daryl, that's it. Yes, Ron, when you asked, yeah, Ron, we're going to be doing some hedging webinars in the future here, but you said, do you prefer to enter as close to at the money as you can? Well, again, it all depends on my strategy. If I'm trying to mimic the market, you know, as much as possible, yes, I'm trying to get in as close as possible. But if there's big events coming out, big news events, for example, Ron, that could move the market quite a bit, but we don't know until the news comes out, you know, if it's going to go up or go down, then I'm probably looking for some protection there closer to the floor or ceiling. Okay, that makes sense? And also another thing to consider is this, Ron, real quick here and everybody else. One last point, then I'm going to let you go. But let's say that, you know, I'm looking at these spreads right here, okay? And how much do I have to put up to get into this one right here in the middle? $46, right? Okay. How much do I have to put up to get into this one at the top? $3 right now. Okay. So for the amount of money I have to put up out of my account, I'm not talking about, you know, realistic risk or planned risk, just for the amount of money I've got to put up out of my account. How many of these spreads could I get compared to this one spread? Here I have to put up 40-something bucks. Here I only got to put up 3. I could probably get 12 of these spreads for the same amount out of my account as one of these. Make sense? Now, am I telling you to go do that all the time? No, because if I got 12 of these spreads and the market only moved a very little, I wouldn't make any money because of the premium I had to pay, right? But if it's a news event and I'm expecting historically a 100 pip move in the market, I don't know till after the news comes out if that's 100 pips up or 100 pips down, right? But if I think it's going to be up, but I want to protect myself here and buy in close to the floor, only risking $3, I could get quite a few of these, couldn't I? Okay, so see that, Ron? So those are the things you have to consider. Is what is the strategy you're trying to match right there? Okay. More costly again. I could get an intraday, but what about the day that spreadsheet? Jimmy, on morning when NQ has already moved like 30, 40 points long before they open, the spreads become more costly to get into. I could get into an intraday, but what about a daily when it's very cheap? The only thing I'm concerned is there I have to be sure it's going to reverse for a short. Yeah, that's yeah, Jimmy. That's the thing you have to look at, is because, you know, especially with NQ, it ticks a little bit differently with spreads. You have to look at that premium and see what the pricing is. And yes, it definitely could be a little more costly. You can do the intradays, but you'll get closer to the underlying market, you know, if you do the dailies and do the middle spreads. But yeah, you do have to put up quite a bit to get into it. But again, remember, even if it's a 400 pip wide spread and you're getting in the middle, or even not in the middle, like higher up, and you're having to put up $300 to get in, okay? Again, that's not an all or nothing risk. If you had to put up $300 to get in, but then the market goes against you 20 points, and you're like, oh, I was wrong, just get out. Even though you had to put up 300 to get in it, as long as you're managing your trade, it goes against you 20 pips, 20 ticks, and you get out, it's still only a $20 loss. Does that make sense? So you got to keep that in mind. You know, that yes, you might have to put up more to get into the one you want, but if you're managing, you know, your risk, you know, it's manageable. Now, what about getting into one of the cheaper ones where you're not putting up as much? Yep, that's like you said, hey, it already went up 30 or 40 points, so I can get a low risk one to go back the other way. There's a lot of premium in it. There's got to be something telling you, your strategy system, your charts, your indicators, something has to be telling you, hey, it's going to now go the other way, and I have an expected move of it to go, you know, 60, 70 points back the other way. So I don't mind giving up 15 or 20 in premium. But you can't just go in there, and I'm not just saying this to you, Jimmy, but to everybody. You can't just go in there and just start automatically buying cheap spreads all day. You have to have a reason for it. Otherwise, you're just going to be paying premium all day. Does that make sense, guys? Okay, so there's got to be a reason for it. It's got to match your strategy, your system, what the chart's telling you, what the market's telling you. Ron says, yeah, potential on 12 $4 spreads is significantly higher. Great tip. Exactly. When you look at if it makes that big move and you're not so worried about paying that premium of $10 because you got 90 others and you got 12 of them. Right, Ron? Okay. Yeah, Jimmy, it'd be cheap at proximity to the market. But yeah, it can be very far away, especially on NQ. Okay. Especially on NQ when that thing has moved a lot. If the spreads don't line up just right for me on NQ, I normally, you know, look over at, you know, RTY, the Russell or the Dow. You know, you just got to look and see, you know, what you've got there. But don't forget those 2-hour spreads as well. Okay. It all depends on the premium of the day. You got to look and see, does something line up right there for you. So, okay, guys, I appreciate your time today. I went way over time here, so I'm sorry to hold you up, but I hope that helped you understand a little bit more about Nadex Spreads, about how to choose the right one, how to not just look at your risk and reward, but also to look at where you're buying in. What is the price you're getting in at? And make sure that you're choosing the right spread for the right strategy, and that will turn your spread trading around. And I hope that helps some light bulbs go off for some of you. So, all right, guys, also feel free to visit us over at apexinvesting.com. We've got tons of free education over there, some step-by-step training courses on binaries and spreads, a lot of good binary and spread strategies and systems, some free deviation levels, some free charts. It's a free basic membership to get into all that education. If you have any questions, let us know. Make sure to visit nadex.com, get signed up for any upcoming webinars, and we will see you next time here. I hope all of you have a very happy, very great, and very safe Merry Christmas with your friends, family, and loved ones. So we will not be doing a Apex webinar next week here with you, but we'll be on after. There are some other webinars. Check out the calendar. But I wish you and your family a very, very Merry Christmas. And thank you so much for always being on and being a great crowd and great questions, good interaction. Enjoy your holiday, and we will see you soon with some great stuff. All right, guys. Thanks so much. Have a good one. You too, guys. Thank you, Lau. Thank you, Lou. All right. Thank you. Bye.